Okay, this video will be a more complicated, more complex calculation of the cost of financing of a company. Now, the term we use is weighted average cost of capital. A corporation uses many sources of financing. For long-term financing, there are four. They use debt, they issue bonds, they could issue preferred stock, and then they have two sources of common equity. They can utilize internally generated capital or retained earnings, or they can use new common stock, or the cost of new common stock. So as we go through this example, we're going to discuss how you calculate these sources, or the cost of the sources, and then we're going to talk about how you utilize that in some decision making. So let's talk about a bond. This company has a coupon. It's an $80 or an 8% coupon bond, right? They have the price of this bond is currently $850. This bond has 20 years of maturity. Now, it's going to cost something to issue this bond. There are some financing information that we need to understand. So the flotation costs are roughly going to be about $40. So we're going to have $40 of the flotation cost. So every bond that they sell at $850, they're only actually going to receive $810 because it's going to cost $40 to issue it. The company is in a 35% tax bracket, and of course the par value of bonds is $1,000. So in this case, we know that the before tax cost of debt is 10.27%. Now, since we've incorporated the tax rate, we can then also calculate the after-tax cost. The after-tax cost is 6.68%. So, when the company issues debt, this is essentially what it's going to cost them every time they issue a debt, or every time they issue a bond. So now let's talk about preferred stock. In this case, we have the dividend that we have here. Let's say that it's a $8 dividend, right? So every time we issue a dividend, it's going to cost us $8. The current price of this preferred stock is $27, and its flotation costs are $4. So again, if you think about it, every time they issue a stock, they're going to receive $27, but $4 of that is already spent because they had to issue the debt. So now you can see that the cost of preferred is actually way too high. So let's make this a higher number. Let's say it's $98. And again, I'm trying to get this to make some semblance of order here. Let's make it $75. I'm trying to get them great. So now you can see that the cost of debt's 10.27%, and the cost of preferred is 11.2%. Now, when we go down to look at the after cost, what you can see is what? That the 11.2% is higher than the debt, which we would expect, but it's also equal to the before tax cost. Since dividends are not impacted by taxes, at least to the corporation, there's no impact on the after-tax cost. Okay, so now let's think about the cost of retained earnings. Now, there's a couple of the cost of using equity. There's a couple of things we can do to calculate this. So first of all, let's just talk about this company. They have a stock that's selling for $55. $55 is the selling price of the stock. They expect to pay a dividend next year of $4.50. So we put here $4.50 is next year's dividend. Now, we could have done a calculation with growth. We could have said that the dividend was, in fact, let's just go do this. it was $4 was the dividend, and it's let's just say it's 10%, right? So now we can get rid of this. Oh, that needed to be 0.10, 10%. So now we have the dividend is $4, growth rate's 10. So next year it's going to be $4.40. So that's in the ballpark. So let's continue on with that. They've been expecting to grow for a while, right? So we're going to continue to grow at 10%. The flotation cost for this company, let's say that they're $3 per share. But now we also have to incorporate here the idea of an underpricing. And we've talked about this in the video, in the lecture, etc. The reason they have to underprice is this company already has stock that trades. They need to sell this new stock to buy an asset. So in this case, the reason we have to underprice it is they could pay $55 and buy the currently issued stock. But if we can lower that price, let's say we lower it to $53. So we're going to add another $2 to the flotation cost so that we can, people will buy this stock before they'll buy the other. It's just a marketing ploy to get the company to ultimately purchase this new stock. And what you can see now is we have a cost of the new issue up here that's 18.8%. So now what we have to do now is we also want to incorporate something here that includes maybe the capital asset pricing model. And if you don't mind, I'm going to play with this number a little bit so that I can get the to have it make a little bit of sense, right? So we're going to say the cost of risk-free rate is that 10%, and I need to have a beta of 1.85. So what does that give me? That gives me a cost of retained earnings of 15.95 using this security market line formula, and 18% using the dividend formula. And this makes a little bit of sense. The cost of retained earnings is less than the cost of new common stock. Again, not by much, but it is less. So how does that fit into our after-tax cost function? This calculation right here is an average. It's the average of these two numbers. So we're saying that roughly the cost of new equity in the form of internally generated capital or retained earnings is roughly 16.9% or 17%. And if you have to issue new common stock, we're at 18.8%. So again, if you think about the cost structure, this makes sense. The cheapest source of financing is debt. The most expensive source of financing is issuing new common stock, and we have the right order. So the next step, now that we understand the cost structure, we have to look and see, well, what is the company's current capital structure? What does it look like? So let's say we have $500,000 worth of debt. We have $30,000 worth of preferred stock, and we have $1.2 million worth of equity. So our entire capital structure is $1.73 million. Our weights are structured, right? 28.9% is debt, 1.7 is common is preferred stock, and then equity is 69.36%. Beautiful. So now we have our basic capital structure. We're going to add a complication here in a second, but for right now, if you look down here, the first break point, when this company first starts to gather money from $0 to when they run out of retained earnings. So they're only going to be using retained earnings as their equity financing. It costs the company 13.9% to gather money for the company. Anything over retained earnings. So if they need more equity, to gather more equity than they do in retained earnings, then they're going to have to go outside the company to get equity. And of course, we know that the cost of equity goes up. So that new cost will be 15.17%. So the complication that we can add to this is we understand a little bit about this company's capital structure. We have two things that we can add to this. When they went to the bank and they talked about borrowing money, the bank says, we will lend you up to $200,000. And at $200,000, the cost of financing is going to go up for the company. So the cost of the company is going to go up. Well, what's it going to go up to? Well, we need to have the new after-tax cost. So the old after-tax cost is 6.68%. So let's just say that the new one is going to be 8%. So now we have a difference in cost structure here. We know that what? You're going to start out in the beginning at this 13.9%, but then later on it's going to jump up because we'll run out of the cheap financing of debt. And if we still need more debt, if we need to borrow more than if we go over $692,000 in financing, we're going to have to pay more for the debt. Likewise, so what do we think is going to be the retained earnings for the next year? Well, let's say we're going to get $300,000 in retained earnings next year. Let's make it a little bit bigger so I want this to make a little bit more sense, so easier to understand. So now we have a capital structure that says, look, when you start to finance, you're going to run out of retained earnings. It's not an infinite amount. It comes from the profits of the company. We predict you're only going to have $700,000. So what we now have created is a table or a cost structure, if you will, of how the company finances its debt. The first tier goes from 0 to the very first break point. From 0 to $692,000 of financing, it's going to cost 13.9%. From $692,000 to $1,009,000, right? At this point, we're using the more expensive debt, we're still using preferred stock, and we're still using retained earnings. When we get to $1 million, $1,009,000, the cost structure is going to increase, right? It's going to go up to 14.28% because in this case, we're now using that more expensive debt. So it went up this little trickle here, it went up. But above $1 million, we're now using not just more expensive debt, but we're now using more expensive equity. So now the final break point is this 15.5%. So if the company says, we need to gather $2 million, what's it going to cost the company to gather the $2 million? Well, each layer of financing has a different price tag. The last amount, from $1,009,000 to $2 million, is going to be financed at 15.5%. So again, the purpose of this process, of this category, is to try to understand when a company goes to gather money, what is the cost to the company of gathering money and using that to finance expansion, etc. So hopefully that helped you answer some questions about calculating the weighted average cost of capital.